In the world of trading, legends are rare. But once in a while, someone breaks the mold. One man turned a borrowed $1,600 into over $200 million. Not with luck, not with a secret algorithm, but with psychological mastery and raw discipline. This is the story of Richard Dennis, the man who proved that traders are made, not born. And in this video, you'll uncover his 7-figure mental blueprint. The habits, beliefs, and inner frameworks that forged the turtle traders and redefined market psychology forever. In the heart of Chicago during the 1970s, a young man named Richard Dennis took a bold step into the chaotic world of commodity trading. He wasn't a typical Wall Street archetype. He was quiet, scholarly, and came from a modest background. With just $1,600 that he borrowed from his family, Dennis entered the Mid-America Commodity Exchange, a small futures exchange where minimum position sizes were lower than the larger exchanges. This moment would become one of the most iconic starting points in financial history. Dennis didn't begin his journey with insider knowledge or a powerful network. He began with an idea, a belief that trends could be followed systematically and profitably. His approach was radically different from most traders at the time. While others relied on intuition and gut feeling, Dennis sought consistency, objectivity, and discipline. He understood that emotional impulses were a trader's worst enemy. Instead of trying to predict the market's every move, he focused on developing rules that could be repeated regardless of market conditions. His initial trades were small. He wasn't trying to get rich quick. He was trying to build a foundation of process over prediction. When his $1,600 turned into $3,000 and then $10,000, people started noticing. But Dennis remained focused. He knew that the real battle wasn't against the market, it was against himself. Every trade tested his ability to remain emotionally neutral and stick to his rules. Over the next decade, Richard Dennis turned that borrowed $1,600 into over $200 million. It wasn't magic. It wasn't luck. It was discipline. It was the result of following a proven system with unwavering consistency. He became a legend not because he was right all the time, but because he was mentally prepared to be wrong and still execute flawlessly. Richard Dennis didn't fit the mold of the aggressive, fast-talking trader. His brilliance came from his ability to stay detached from the chaos around him. He viewed the market as a reflection of human behavior, and his job wasn't to outsmart it, but to respond to it with clarity and control. He believed that trading was a psychological game more than anything else. Intelligence, while useful, was not the determining factor of success. Emotional stability and discipline were far more important. One of the most striking aspects of Dennis's trading mindset was his refusal to let ego interfere with execution. He didn't trade to be right. He traded to make money. If the system said to enter a trade, he did it, even if his personal opinion contradicted it. This separation of self from strategy is what allowed him to remain consistent when others crumbled under pressure. He built systems that were mechanical, meaning they removed decision-making from the heat of the moment. Every rule was predefined. Entry points, exit points, position sizing. It was all written down and followed religiously. By doing this, he avoided the common psychological pitfalls that destroy traders: overtrading, revenge trading, and chasing losses. Dennis also maintained a deep curiosity about how markets worked. He constantly tested new ideas, but never let curiosity override discipline. He understood that even the best system would have losing periods, and he was mentally prepared for them. Losses didn't shake his confidence because his confidence was rooted in the process, not the outcome of individual trades. Trading, for Dennis, wasn't about predicting the future. It was about aligning with trends and managing risk. It was about humility, the humility to admit when he was wrong and the restraint to avoid reacting emotionally. His success was a direct result of his ability to master the psychological game that most traders lose. In a world that celebrates intelligence, Richard Dennis made a compelling case for the power of rules. He believed that the market didn't reward those who were the smartest, but those who were the most consistent. His trading system was simple yet powerful. It was based on trend following, which meant buying markets that were going up and selling markets that were going down. The genius of the system wasn't in its complexity, it was in its structure. Every trade was governed by clear rules. There was no room for discretion, no place for emotional decision-making. Dennis knew that when traders rely on gut feelings, they inevitably make mistakes. Emotions cloud judgment. Rules create clarity. He often said that you could publish the rules in a newspaper and no one would follow them. Why? Because following rules is hard. It requires discipline, especially when the market moves against you. But Dennis did follow them. He trusted his system more than he trusted himself. And that's what gave him an edge. His system defined risk per trade, total exposure, and exit strategies. This structure allowed him to trade with confidence, even during volatile periods. He didn't second-guess his trades. He didn't chase after losses. He stayed the course. And because of that, he was able to survive the downturns and thrive in the upswings. Richard Dennis's success wasn't about brilliance. It was about behavior. He understood that markets are uncertain, but behavior can be controlled. By focusing on what he could control, his rules, his reactions, and his risk, he put himself in a position to win over the long run. He didn't try to conquer the market. He conquered himself. One of the core beliefs that defined Richard Dennis's approach to trading was his rejection of prediction. He didn't believe in trying to forecast market tops or bottoms. He believed in reacting to what the market was doing in real time. This shift from prediction to discipline is one of the most powerful psychological transformations a trader can make. Prediction feeds the ego. It makes you feel smart, but it also makes you vulnerable. When traders try to predict, they often become emotionally attached to their forecasts. They hold on to losing positions, hoping the market will reverse. They ignore warning signs because they don't want to be wrong. Dennis eliminated this problem by focusing on trends. If a market was moving in a certain direction, he went with it. He didn't try to guess when it would stop. He just followed the rules. When the trend ended, he exited. No drama. No denial. This approach requires tremendous psychological discipline. It means accepting that you will never buy at the bottom or sell at the top. It means being okay with being wrong, as long as you followed the system. It means putting ego aside and prioritizing consistency over cleverness. Dennis taught that success comes from following the process, not from predicting the outcome. He trained himself to act without hesitation when his system gave a signal. Whether the last trade was a winner or a loser didn't matter. Each trade was its own event. The past didn't influence the present. This kind of mental clarity is rare. Most traders carry emotional baggage from one trade to the next. Dennis didn't. He had a short memory for outcomes and a long memory for rules. And that's what made him one of the most disciplined traders of all time. In 1983, Richard Dennis and his longtime friend and business partner William Eckhart had a heated debate. Dennis believed that great traders could be trained. Eckhart disagreed. He thought trading success required innate talent. To settle the argument, Dennis proposed an experiment. He would recruit a group of people from all walks of life, teach them his trading principles, and see if they could succeed. This group would become known as the Turtle Traders. Dennis placed ads in financial publications inviting applicants to join his training program. He received thousands of responses and ultimately selected a diverse group: accountants, software developers, gamblers, and even a security guard. None of them were professional traders. That was the point. Dennis wanted to prove that anyone, regardless of background, could learn to trade if they had the right mindset and followed the system. The training lasted just 2 weeks. During this time, Dennis taught them his rules-based system in detail. They learned how to identify trends, manage risk, size positions, and exit trades. But more importantly, they were taught to detach emotionally from their trades and stick to the rules no matter what. The psychological conditioning was just as important as the technical instruction. Once training ended, Dennis gave each turtle a trading account with real capital. The results were extraordinary. Many of the turtles went on to make millions. Some of them continued trading successfully for decades. What made this experiment so groundbreaking wasn't just the profits. It was the proof that trading discipline could be taught. The success of the turtles validated Dennis's core belief. With the right system and the right mindset, anyone could win in the markets. The turtle experiment remains one of the most compelling stories in trading history. It demonstrated that success is not reserved for the chosen few. It's available to anyone willing to commit to a process, embrace discipline, and master the psychology of trading. For Richard Dennis, losing was never a personal failure. It was part of the process. He knew that even the most effective trading systems would generate losses, sometimes several in a row. But what separated him from most traders was his ability to handle those losses without emotional breakdown. He didn't fight the market. He accepted that losses were the cost of doing business. They didn't define him. They didn't shake his belief in the system. This mindset is crucial because most traders equate a losing trade with personal inadequacy. They feel embarrassed, frustrated, or even ashamed. These emotions cloud judgment and lead to impulsive behavior. Dennis trained himself and his turtles to remain emotionally neutral. A loss was simply data, feedback from the market, not a reflection of one's worth. He often emphasized the importance of keeping risk per trade small. By doing so, no single trade could damage the trader psychologically or financially. This approach created a mental buffer. If the system generated a loss, it was manageable. It didn't trigger panic. It didn't tempt the trader to abandon the process. Dennis also taught that after a string of losses, the most important thing was to continue following the system. Most traders, after 3 or 4 consecutive losing trades, begin to doubt the strategy. They hesitate. They alter rules. They sit on the sidelines just when the edge is about to pay off. Dennis understood that edge plays out over time, not in a handful of trades. Maintaining faith in the process during tough times is what allowed him to recover and capitalize on opportunities. The ability to lose without losing your mind is what turns a good trader into a great one. Dennis knew this, and he made it the cornerstone of his psychological blueprint. Trading success isn't about avoiding losses. It's about responding to them with discipline, calm, and confidence in the system. Richard Dennis's ability to turn a few $1,000s into millions wasn't just about picking the right trades. It was also about how he scaled those trades. Scaling is the art of increasing position size in a way that amplifies returns without increasing emotional risk. Dennis mastered this balance. He knew that growing capital wasn't just about making good trades. It was about compounding those trades through smart position sizing. As traders gain confidence and capital, there's a temptation to scale too quickly. They start taking on larger positions not because the system calls for it, but because they feel invincible. This emotional scaling is dangerous. It turns small losses into devastating ones and makes it harder to stick to the system. Dennis avoided this trap by predefining his scaling strategy. He increased his positions based on account equity, volatility, and risk, not emotion. This level-headed approach to scaling helped him stay consistent. If his account grew by 20%, he didn't double his risk. He let the numbers guide the decision, not the euphoria of success. This discipline protected him from overconfidence and allowed his edge to play out over a longer time horizon. Scaling also required Dennis to stay psychologically grounded. Bigger trades come with bigger emotional swings. Even a seasoned trader can feel the pressure of 6-figure or 7-figure positions. But Dennis trained himself to treat a $1,000 loss the same way he'd treat a $100,000 loss, in context of the system. He didn't let dollar amounts change his behavior. Traders who want to build wealth must understand that scaling is not just mathematical, it's emotional. Richard Dennis knew how to scale without letting greed, fear, or excitement get in the way. That's why his returns were not only massive but sustainable. At the core of Richard Dennis's philosophy was a deep commitment to process over outcome. He believed that results would take care of themselves if the process was followed with discipline. This sounds simple, but it goes against human nature. Most people are outcome-focused. They measure success by wins and failures, by profits and losses. But Dennis knew that this mindset leads to erratic behavior. If traders react to outcomes, they're always one step behind the market. Instead, he trained his mind and the minds of his turtles to stay loyal to the process. If the system signaled a buy, they bought. If the system signaled a sell, they sold. The outcome didn't matter. What mattered was execution. Did they follow the rules? Did they size the trade correctly? Did they manage risk? This level of detachment gave Dennis a psychological edge. He wasn't swayed by short-term success or failure. He understood that the market is full of randomness. A good trade can lose. A bad trade can win. But over time, the process reveals its edge. His job wasn't to chase outcomes. It was to protect the integrity of his system. This mindset also reduced stress. When you focus on process, you stop riding the emotional roller coaster of P&L swings. You stop questioning yourself after every trade. You develop emotional endurance, the ability to keep going, even when the results aren't immediate. Dennis's process-based mentality was the backbone of his long-term success. Most traders fail not because they lack a good system, but because they abandon it under pressure. Richard Dennis didn't. He made peace with uncertainty and anchored his identity not in winning trades, but in following the process. That's what made him unstoppable. Many of the turtles that Richard Dennis trained went on to become millionaire traders. They weren't financial experts. They didn't come from Ivy League schools. They were people who committed to learning and applying a structured process. Their success was proof of Dennis's thesis. Trading is a skill, not a gift. One of the most famous turtles, Curtis Faith, was just 19 years old when he joined the program. He absorbed the rules, internalized the discipline, and went on to generate tens of millions in profits. His story and the stories of others like him showed that with the right environment, the right mentorship, and the right mindset, anyone could excel. What these students had in common was their respect for the rules. They didn't try to outsmart the system. They didn't let emotions dictate their actions. They followed the blueprint Dennis gave them with religious discipline. That's what made the difference. The journey from student to millionaire wasn't easy. There were losing streaks, market chaos, and emotional lows. But the turtles had been trained for this. They knew how to think, how to act, and how to endure. Dennis didn't just teach them how to trade, he taught them how to think like professionals. Their transformation was psychological as much as it was financial. They stopped thinking like gamblers and started thinking like statisticians. They stopped chasing certainty and started embracing probability. This shift in mindset was the real gift Dennis gave them. By the end of the program, Dennis had created a new generation of disciplined, confident, and process-driven traders. Richard Dennis's journey from $1,600 to $200 million wasn't just a financial success story. It was a psychological blueprint, a roadmap for anyone who wants to master the markets not through prediction, but through discipline. His legacy is not just in the trades he made, but in the traders he shaped, and the timeless principles he taught. If you want to follow in his footsteps, you must start by building your own system. Define your rules, make them clear, make them repeatable, then commit to them fully. Your system should tell you when to enter, when to exit, how much to risk, and how to react. Remove as much emotion from the process as possible. Next, focus on your mindset. You must be okay with being wrong. You must accept losses as part of the game. You must stop measuring your success by outcomes and start measuring it by behavior. Did you follow your rules? Did you manage risk? Did you stay disciplined? Scaling your trades is the next level. But it only works if your mind is strong. Don't let success go to your head. Don't let fear hold you back. Increase your size when your account and your emotions can handle it. Always scale from a place of structure, not emotion. Finally, remember that greatness in trading comes from psychological endurance. You will lose. You will doubt. You will be tested. But if you stay consistent, if you commit to the blueprint, success becomes inevitable. This is your invitation to become a turtle, to master the same principles that turned everyday people into millionaires, to embrace a process that prioritizes discipline over drama, and to build a trading mindset strong enough to turn setbacks into setups. Richard Dennis proved that trading is not about talent. It's about training. Now it's your turn to train, your turn to follow the blueprint, your turn to turn discipline into destiny. If this deep dive into the psychology of Richard Dennis inspired you, it's time to take action. Subscribe to Trading Psychology Lab and join a growing tribe of traders committed to mastering not just the market, but their own minds. Share this video with someone who's struggling to stay disciplined. Comment below with the one principle from Richard Dennis you're going to implement starting today. And if you believe in the mission of helping more traders trade with clarity and discipline, consider supporting us on Buy Me a Coffee. Because in the end, it's not the smartest traders who win, it's the most disciplined.